The next topic in this chapter is about management of fixed capital and working capital. So we have to understand what these two terms mean. We know that every business needs funds or needs money for its assets and its activities. Fixed capital refers to the long-term assets and the long-term investments that a company uses to generate revenue. Examples of fixed capital are the plant and machinery and the other equipment used in the business, land and buildings, vehicles, furniture and fixtures. These fixed assets are not consumed or sold during normal business, but they are essential for the production of the goods or services that are actually sold by the business. Fixed capital is typically tied up in physical assets that have a useful life of more than 1 year, and fixed capital is not liquid. Fixed capital assets lose value over time due to wear and tear, which is accounted for through depreciation. For example, a machine used in a factory may have a useful life of 5 years, after which it has to be replaced, which means that every year the machine will depreciate and its value will eventually become zero, or it will reach scrap value after 5 years. Fixed capital assets require a large initial investment to acquire, like the money that is required to buy land or buildings. But the benefits of fixed capital assets are reaped over a longer period of time. Working capital refers to the short-term assets and liabilities that a company uses in its day-to-day operations. Examples of working capital are cash, inventories, bills receivable, and debtors. Now, working capital is the difference between a company's current assets like cash, inventory, and receivables, and its current liabilities like payables and short-term loans. A simple formula to remember how to calculate working capital is working capital is equal to current assets minus current liabilities. In simpler terms, working capital is the money that a business needs to run its day-to-day operations, ensuring liquidity to pay its bills and continue operations smoothly. To summarize, fixed capital is essential for long-term investments in the infrastructure that keeps a business running, whereas working capital is necessary for maintaining liquidity and operational efficiency needed for day-to-day activities.